Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk, good to be back after a week off. Hope you didn't miss me too much and you dried your tears.
Well, we can't miss you if you don't go away, Doug. So,
That's right, exactly. Every once in a while, I got to remind you of my value.
yep. No, it's good. It's good to have you back. Yeah. So, we're officially in June, it's the first week of June, and you know, this year, I have to point this out only because it's just so interesting to me. Typically the markets operate within a a framework that is somewhat similar but not really predictable. This year, however, I feel like things are oddly predictable. And here's what I mean. Most times, trends don't change when a month ends, and they don't start when a month begins. But this year, that's exactly what's been going on. So, January, precious metals did great, although the last day they didn't, but close enough until the end of the month. And then a lot of areas in the market did well in February, especially just general equities and industrials and energy and materials and staples did really well in up until February. And then the war started March 1st, beginning of a new month. And then it ended because apparently the war was over, according to Trump, at the end of March. And then April began. And then the market shot up for a month and then last month. And then June hits, and all of a sudden the markets are selling off. I feel like we're in a simulation. I hate to say that because some people believe that, but it's really weird. We've had a really weird year this year. Why were the markets going up? I don't know. Why are they going down? I don't know. Well, maybe it's because Trump restarted the war, but regardless, the war that had already ended, but apparently it didn't end anyway. You guys get my dry sense of humor. But it's been really interesting to note. When you start to notice patterns in the market, that's probably around the time when everybody know. Let me rephrase that. When you notice patterns in the market that other people don't see, it's really interesting. When everyone starts to see it, the patterns stop working. It's kind of like a self-correcting mechanism. When everyone's doing the same thing, that's when it stops working, right? And naturally, you'd think that, right? Because if everyone is buying tech stocks, well, eventually there's no one else to buy tech stocks, and then the only place they can go is down, right? That's just how market system works. So when everyone is doing the same thing, that's at some point that's going to end, and that applies to all areas of the market. Now, we've been talking about this for a while, but the markets have been odd in the last 2 months. And last week we talked about each separate sector. We have 11 sectors in the index for the S&P 500, and out of those 11 sectors, one of them has been doing well. And the rest were just kind of biding time. They're just kind of staying flat in the last 2 months. And technology sector has pulled all the weight. Now it looks like that may be reversing.
I'm sorry, Kirk, the technology sector or what in the technology sector?
Well, it's a good clarifying question. So if you look at the technology sector, it has done extremely well over the last 2 months. Within the technology sector, there are multiple subsectors. One of which is semiconductors, which has really been pulling all the weight for the sector in the last 2 months. However, software has actually started to come back in the last month and a half. So software had been obliterated, rightfully so, because a lot of companies aren't going to do well with AI in the future. But apparently everyone thinks that's okay, and the software sector has started to come back. Primarily, the returns have been through semis, though. And a lot of people don't know that. And they just think, well, the markets are up, everything's doing well. Actually, earnings have been going well. So earnings season is more or less over. And you still see some companies here and there. There were some this week, and there'll be some smattering of some over the next month or two. But basically, earnings season's over. And overall, earnings were good across the board. Now, if they were good, why hasn't the market taken off? Don't know. Maybe because it's overvalued. There could be many reasons, but it hasn't. And we've seen huge changes in stock price after earnings. And we're seeing some 5, 10, 15, 20% or more moves in stock prices. And these are not small stocks. Some of these are big stocks making these moves after earnings season. What that shows me is that people are vastly off balance with their portfolios. And I think the thing to keep in mind is it's really easy to get excited and to want to put all your money into the areas that are doing well. But the hard part is you don't know when that's going to stop, and you don't know what's going to violently change. I mean, as of right now, the semiconductor sector is down 4.6%, when the S&P is down less than 1%. Does that mean it's going to be a new trend? No, but it's just something to keep in mind that when you buy things that are skyrocketing to the moon, like a rocket ship, you should expect that it's not going to go up that way forever. When that happens, like take for instance silver earlier this year. Silver did really well up until the day before the end of the month, so January 30th. Did really well, and then the 31st you had a huge sell-off. Maybe it was the 30th. I don't know. Oh, the 31st is on the Saturday. So the last day of the trading month, so it was the 30th, when silver dropped like 50%. I'm going to say it wasn't maybe 50, but it was really, really close to it in a day. It had done really well prior to that. It was still above where you started the year, but it was a pretty big loss if you got in late. That can happen. And we're in a market, and I'm just going to kind of clear the table here. We're in a market where, for the most part, the market is staying flat as we predicted it would, but there's an excess sloshing of money. And this is not new. It's been there for a while. It used to go into tech. And then last year, I would say right around late summer, maybe even September, that changed. So it went from tech, it went into crypto, then crypto softened, and then that sold off. And then it went to precious metals. And then precious metals sold off. Then it went into energy. And then, well, energy hasn't sold off, but people aren't really investing in energy anymore. And now it's gone into semiconductors. So if you look at the market like a pool, and then you've got a big fat guy doing a cannonball into the pool, it's going to slosh the water around in different places, right? And so what's basically happened is, because of the massive amounts of money in our financial system, it's just sloshing from one place to the next, and it's not healthy, to be clear. Now, why should you care? Well, you shouldn't. You should just focus on what's doing well. But my point is that while the stock market is not doing well as a whole, one area is causing the index to go up because it's a third of the entire index, and that's semiconductors, technology, what have you. It's something to keep in mind, because when that changes, all that money goes into another area. I don't know what area it's going in. Right now, it's not going into crypto because Bitcoin is down quite a bit in the last week, I would say. I think it's gone from like 73,000 down to maybe it's like 60,000 now. I don't know where that stops, but it's certainly not looking good. Bitcoin's down 5% today. Ethereum's down almost 10%, just maybe 5.5, 9.5 right around right now. That's down a lot. Our prediction on Bitcoin was that if you look at prior booms and busts of Bitcoin, our target is around 37,000. And that's just math. It's just looking at patterns and saying, this is what I would expect given this. Well, if that's the case, then it's going to be not cut in half, but it's going to be down maybe 40%, somewhere thereabouts. I wouldn't be getting all excited about buying Bitcoin. I would just wait, right? Because what tends to happen is people buy Bitcoin. The best time to buy Bitcoin is when no one's talking about it. Everybody's disgusted with it. They've lost everything, and they're like, I'm never doing this ever again. And when the last person leaves, that's the time to buy. Which, if things go on at this rate, might be towards the end of the year, which would be a great time for tax loss selling and things like that. I would just keep in mind that if you're looking for hot dots, you have to know when to get in and when to get out. If you're a normal investor, then just be patient. There's nothing wrong with keeping your money in short-term treasuries earning 4% plus in interest, just waiting with virtually no risk, right? Of course, there's risk in everything, but virtually no. It's as close to zero risk as you can get in short-term treasuries. Why not? I mean, what do you have to lose? You make 4% a year, or even if the market's up 10, who cares? Like if the market's run by one sector, I think this is the one thing I'm going to leave you with this, and I'm going to move over to Doug. One thing I can leave you with for wisdom, I've been doing this for 26 years, a little bit of wisdom is this. Don't feel like you need to keep up with the Joneses. Don't have FOMO. Don't worry about what the index is doing. The index is an interesting indicator, but it's not always a good indicator. Focus on your game. What is your game? Is your game value investing? Is it indexing? Is it momentum investing, trend following? Whatever it is, focus on your game. Don't worry about what the market's doing. If your game is working, keep working your game. Don't focus on what other people are doing, right? If you're playing a high school hockey game and you're worried about what the NHL is doing, you're missing it. It's a different game. It's not your game. It's a different level. It's different people. That's not what you're doing, right? Focus on what you're doing. As long as it's working, keep working your game. Don't worry about what the index is doing. The index is going to cause more problems for people this year than anything, because people are trying to chase returns right now and they're going to get burned. If this week is any indication, then this week, this month, and next month may be rough months. But I suspect Q4 is going to be a good quarter. We had good jobs this week, but in general, I would say just be very cautious. I'm still marking my plan. Patience and caution are the words of the week or the month or the year. I'm sticking with that story. And what are your thoughts, Doug?
Well, I think from a starting point standpoint for this week, you know, the labor market just came out with some new information, which I think was something you can always take as a grain of salt. We've seen lots of different labor numbers that have come in and out over the years, and lots of revisions. Although interesting, we didn't really see a major revision from last month. We saw 172,000 that just came out yesterday versus 85,000 expected. That's certainly the first reaction to that. Of course, the economy is strong. It beats expectations. Unemployment steady at 4.3%. Upward revision. So, of course, the headlines look at this as a really bullish take. I think a smarter take on that, it is a good number, but is not necessarily a great symbol for the markets. And here's why. Strong jobs leads to the Fed staying tight. And ultimately, what is the Fed, what does the president want? The president wants, them to drop rates. The president, the economy, we know this, that when cheap money tends to be, gas, octane in the tank. The market doesn't care about growth. It cares about policy. So this strong labor market is, from a policy standpoint, really works some headwinds. The Fed has no urgency to cut rates. And again, who knows where the mindset of the new Fed chair is going to come in, but certainly doesn't make this, a catalyst. That means that we could be stuck with higher for longer interest rates if we keep getting these numbers. That could lead to negativity for equities, valuation pressure. Can also mean more negativity for crypto because of tight liquidity. Now, you mentioned money flowing in, and it has been. I did talk in a couple of weeks ago that we did see a spike in M2 money supply, where that, various reasons why that came in, but this is not bullish for money supply going forward. There's a good news, bad news dynamic. The good economic data ultimately can lead to less stimulus, tighter financial conditions, but it also confirms that we could be in a late cycle strength. And we are, and this also ties in, by the way, to something else that's come out. if you've heard, SpaceX is about to release the most, the highest valuation IPO in history. But that is also aligning with a lot of other IPO data that's coming out. We've seen recently, that there's starting to be this pop in potential rising IPO activity. And that is exactly what a late stage cycle looks like. Strong data on the surface, tightening conditions underneath, the strong employment aligns with that, rising IPO activity aligns with that, speculative assets like Bitcoin weakening, that combination matters a lot. This 64,000 job revision is key. Labor market's not cracking yet. It's gradual. If we can get to a point in which we can sustain these jobs, then the Fed doesn't have any reaction. If we start to get revisions, which we've seen before, then there's an opportunity. Then that again, that can come very fast and all of a sudden make the markets really react suddenly. So I think where we're at right now, all of the when we got strong jobs, rising IPO activity, Bitcoin pulling back, it's not random. It's a liquidity being repriced across the system. And what does that mean going into the summer? Because here we are, it's June, right? Sell in May and go away. Well, we got through May. May was a contrarian to the historic volatility, but we still have upcoming midterm elections. We're starting to get some results of some elections coming through in various states and governor races and things like that. The base case is that the Fed could stay cautious. Markets could still become choppy, rotational, headline driven. It's not a breakout environment. It's a positioning environment. Ultimately, the economy is strong enough to prevent a crash, which is good, but it's also strong enough to prevent these rate cuts. We're stuck in a market where the strength can delay relief. Markets, they don't move on data, they move on liquidity. Strong jobs don't add more liquidity. And ultimately, I think, again, if we look at, we've had an extremely long cycle in this in the secular bull market that has effectively been rising since the last Great Recession, with a couple cyclical pullbacks in between, most of which have just been black swan related, like 2020, or the Fed raising interest rates in 2022, 23. Other than that, the markets have been pretty much on a heater since the bottom of the Great Recession. So we're way, way, way beyond normal cycle resets. And it's taken a long time with all of the liquidity in the markets that, of course, that we were already in a great liquidity standpoint with low interest rates for such a long time. Then you take COVID, you inject just massive nitrous into the tank of liquidity. That created this, other than that, interest rate blip in 23, created another heater where now we're going on 2-3 years of double digits, if not 20+% returns. We're finally getting to a point in which data does seem to be aligning for the most part, in a clear look of late stage economy. And it's taking almost 20 years to get there, which is insane. So from that standpoint, it is a time to start really thinking hard about being cautious. Like you said, don't panic. There's nothing that says that there's going to be a rug pulled out. We do have, again, who knows what's going to happen with the midterms? Again, expect volatility. Who knows what's going to happen with the Iran? I mean, good, every day we are either agreeing with, we're making a treaty and resolving this conflict, or they walk away from the table pounding it mad, having a temper tantrum. That's going to create additional volatility that's going to happen in there. But it's telling the same story to me, that we're in this tight late stage economy, and that means that they don't break immediately, but it does make it a lot harder to win in, which is why if you look beyond this tech that you're talking about, Kirk, you look beyond AI and semiconductors and whatever's going to occur with this IPO, which by the way, for those that are excited about it, it is already extremely valued. I want to just throw this in there really quickly. SpaceX is hemorrhaging money, but then again, so is Tesla, right? It was hemorrhaging money when they went public. There is a track record of reason to believe that Musk is going to be successful in this endeavor because at least you know over the I mean the data is there that he's kind of like Midas, right? Everything he touches turns to gold. At least it has. Now that doesn't mean forever, and when it comes out this expensive with something that ultimately SpaceX's only way to really turn profitable is going to eventually be able to capitalize on being able to occupy Mars or space mining or things like that, which have other effects, right? If we all of a sudden discover an asteroid made of pure gold, you're going to take gold, right? There's a supply issue. The reason gold is expensive is it's rare. It's hard to find. It's hard to mine. The reason diamonds were expensive for a long time is because, artificially De Beers was hiding 90% of them. When you oversupply something, I love to talk about, hey, there's an asteroid out there that's made of pure diamonds. That wouldn't be good for diamonds. If an asteroid of pure gold would not be good for gold, it would end up being something that would be effectively, aluminum, which is the most abundant element on Earth or one of them. So it's not like this would be great to all of a sudden find all of this, these elements. Now, it might be very helpful to find things like helium, which is something that is a rare supply on Earth, and certainly something necessary for a lot of the technology development that's out there. But there is so much long-term hope that comes from what SpaceX could create, and it's going to hemorrhage money getting there because every time they shoot up in space, there's no return on that investment immediately. So just to look at the excitement beyond that, it's already expensive. 2/3 to 3/4 of all IPOs tend to underperform. They tend to create that froth, that excitement, right, coming out of it. News today that if you were a longtime Tesla holder over 10 years, they're now allowing Tesla stockholders to be able to join in on this IPO. So that's gonna, who knows what kind of excitement that's gonna get, or the consumer, the retail consumer buying in. On top of that, they've lowered the minimum to get in. You're gonna see some. I expect you're gonna see some froth going into that, but ultimately there becomes this reality set that happens after IPOs. And the spike in IPOs is definitely late stage focused. But when you get beyond that spike and you start getting into fundamentals of it, there tends to be a pullout. And most of the time, about 65 to 75% of IPOs are actually a better value on the secondary market 6 to 12 months later. So if you're a betting person, that might be a better time to consider getting into these IPOs. But that also means 1/3 of them blow it up and are exactly, as successful as they hope to be. And so, of course, you might be looking back crying a little bit if you didn't get into it early. But I would say that that's going to create some hype right now. And ultimately, I don't think that that's necessarily something that, is going to be bigger than the news that's out there right now. I did just show a chart just to kind of, throw this back to you, but you talked about Bitcoin and just kind of like the cycle that it's in. It's something that there is, a couple different ways to look at Bitcoin right now. I think overall in terms of the chart, I think, what did you just say? You thought it was, 35,000 was probably
37.
where, what did you say, Kirk? Is that it?
37,000 is my
37,000. That actually makes sense. So right now, there's a couple of charts. I'm showing one of them that tends to show the cycles of Bitcoin that we've already seen. There is, an argument say don't catch a falling knife. It is, Bitcoin has had historical drawdowns of 75 to 85%. The time cycles, that if we were to follow this extrapolation model, you are looking at more downside on Bitcoin following it into late 2026. Um, Now, there is another model called the Wyckoff model. It's a reaccumulation, big move higher. There are some people that are believing that structural pattern of distribution to accumulation, now to expansion, that, that we're just in a small shakeout before a major move higher. And this is what we call a market structure interpretation. The truth is, they're both solving, different problems. One is measuring time. The other is interpreting behavior. The cycle model is kind of a when. The Wyckoff model is a what phase model, and they can both be partially right. It isn't following here's the real takeaway. It's not following a clean cycle anymore. It's transitioning more into a liquidity driven macro asset, which changes everything. With liquidity being tight, strong jobs, and the Fed not cutting to kind of round this round, rates elevated, that's going to be bearish for crypto without more liquidity. If we look at post-parabolic behavior, every major Bitcoin run it tends to overshoot. Then you fall into a mean, hard reversion. The big inflows, especially from an ETF standpoint, with retail access to it, they've already happened. Now we've moved into a digestion phase, not an expansion phase. And I think there's a merit behind this higher later case. The institutional floor still exists. ETFs, sovereign interest, corporate balance sheets. We're not in 2018 anymore. It's definitely had more acceptance. The supply dynamics of halving has already happened. Long-term supply is tightening. If we look, if structural trends still up, if we zoom out though, we're going to have, higher highs, higher lows. It's not a straight up or down. It's a volatility compression phase inside a larger uptrend. If we take a look at where this could go, if liquidity loosens, it could rip higher. If liquidity stays tight, it could chop and bleed lower. And if we have a shock event, we could see a greater drop that could come very, very fast. If we look at the time-based estimate, just to kind of round it back to you, the last all-time high was October 2025. That, estimated bottom predictions would be around October 2026. That time-based estimate would be kind of a 54 to 55,000 block from all-time high. If we look at prior cycles, 85% drop, 83% drop, 75% drop. This current cycle less likely severe due to this institutional adoption. 75% drop from the all-time high of 128 would put us right at that $32,000 target. 65 would put us about 45, and a 50% drop would put us around 64, which we've already moved past because it's already at 62. This means that the model is implying there's probably more likely downside into that 30 to 50%, or I'm sorry, $30,000 to $50,000 range that you were talking, Kirk, over the next 6 months. And that is assuming, though, that Bitcoin behaves like past cycles. But just keep in mind, the ETFs do create a new demand floor. Institutions may have less panic selling than before. Macro liquidity is the dominant driver now. So realistically, I think that late 2026 is plausible. 75, 85% crash, possible, less likely. But I do think that getting somewhere between 30 to 50,000 is absolutely a valid target.
Yeah, if you look at prior cycles, prior cycles you saw more or less a 70% drawdown from the peak. So if I look at, let me see if I can bring it up here. If I look at the cycle that peaked out in 21, right? It peaked out right around 60, I think it peaked somewhere around 69,000. And then it went down to 15,000. Now that's more than 70%. 70% would be 20. So whatever that ends up being, 75, 80. But, peak to trough, you're looking at a 70% and change drawdown. Now, if you look at the peak, it was 125,000. So 125,000, 70% drawdown brings it down to 37 and a half. Now, it could be more, it could be less. I have no idea, right? We have no idea where the bottom is. But if I'm ballparking a number to shoot for, I would say 37 and a half is a good number to start, to start putting hooks in the water, right? Trying to grab some positions at that price. Now, it could very well go down to like, 25,000 for all I know. I don't know. But I would say that's a price I would start to look at it, right? Until see the way that Bitcoin and other, Bitcoin is like doing the dot-com bubble every few years, because the way it works is people get super excited, they get in, and it shoots the price up. It goes up a few hundred%. That upcycle tends to shrink. It used to be like 1,400%. Now it's like, now it's like 200% or whatever it is. So it's going to keep shrinking, but you still get this pretty good upcycle. And it's a short period of time. It's usually like a year, somewhere thereabouts, where it does really well. And then people lose interest. It's usually combined with some sort of event like Coinbase going public, or ETFs going live, or now they offer futures, and now they offer options. Anytime something happens in the sector, it tends to put downward pressure on the price of. When I speak of crypto, I speak of Bitcoin and Ethereum because they're the biggest two, and they're the most widely used. But I don't know much about the others, and that, frankly, that's it. I'm not preferencing these. It's only because I follow these two. But in general, if you look at the price of Bitcoin, what you'll notice, and look at a logarithmic version so that it's clear, because if you don't look at a logarithmic version, it's going to be all weird. But if you look at the logarithmic version, you can see there's a few 100% upside, and then there's a 70% drawdown, then a few more 100% upside. So you get this stair step higher. Now, for me, I look at this and I say, well, that's an easy investment. You buy it when it's bombed out, when no one wants it, when people are disgusted by it, and they're like, the last curmudgeon's like, I'm going home, I'm never touching this again. And that's when you start to buy, right? There's usually ends up being the end of the year, a lot of tax loss selling, people are trying to get off the books. And that's a great time to buy. And then it starts to go up, and then you ride it. You wait till it goes up to a certain point, take your profits. When it peaks out, maybe you take some more, and then you wait. You sit on the sidelines and you get out of it. There's too many people who are way too involved with Bitcoin, way too involved with crypto, and they are the gold bugs of the crypto sector. Now, if you're one of these people, great. Is it going to be a revolutionary technology? Probably. But do you really want to sit through a 70 to 80% drawdown where you lose 70, 80% of your money? If you buy at the low and it goes up like 400%, and you put in $100, now it's worth 400, you're feeling rich, and then it drops 80%, why would you want to go through that? These cycles are very predictable. They have been for decades. So, like I said, why do you want to go through that? At some point, it seems like, all right, things are shifting and maybe I can sit in the sidelines, because it's not going to go from 16,000 to a million overnight. There's going to be a lot of volatility in between. And if you're willing to sit through the volatility, great, good on you. I'm not willing to do that. If something goes up 100%, I can sell half. I have zero risk because I took my original principal off the table. Maybe that's an interesting strategy to try if you like holding forever. Wait for the drawdown, you buy a bunch more, wait for it goes up a few 100% or 100%, sell half, and then it drops. And then you just keep doing that over and over, and you can compound your growth. And that way you're not taking huge risks like everybody else. There's many ways to play this. And I'm not saying that you have to do it my way. You could just buy it and sit on it and forget it. That's okay too. A lot of people do that. What you need to do is you need to have some risk management in play, whatever that might be, whether it's using options or whether there's some sort of a buying selling strategy, whatever it is. I wouldn't day trade it, but will it go to a million eventually? Maybe, but honestly, by the time it gets to a million, I probably don't want to own it, because the returns that you're getting in the growth, the best returns have already passed, right? Going from 1,000 up to 14,000, that's big growth. Going from 60,000 to 120,000, not so much. So is it still good? Yes. But as the price gets higher and as it gets implemented and integrated into financial systems, what's going to happen is that few 100% growth, that spike growth that people look for, that's going to start to shrink. And some point, it's going to be like 20% growth. Well, what's the point? I don't care about that. That doesn't interest me. I don't care if it's the new technology and it's the AI of the generation. I don't really care. What I care about is what is the risk, what is the reward, right? Because if you invest in Bitcoin and it goes up 5% a year, I'd rather own treasuries, right? Because Bitcoin could go away. Yeah, sure, treasuries can, but it's not going to for many reasons. Bitcoin could. They could pass a law and all of a sudden it drops like 50% overnight. Could happen, right? You don't know. Now, I do think that the administration is pushing more for crypto. I do think that there will be more to come in the crypto sector, and I think the upside is there. But right now, it's not, and I have no interest. So if you guys want to invest in it, that's great. Good on you. I have no interest though. What I'm looking for is I'm looking for better entries, things that are low risk, and I can just sit and wait and wait until it pays off. Same thing with gold. I hate to say it, I love gold, but I do think that gold is probably going to sell off a bit more than where it is now. I think there was way too much interest in gold last year. Fortunately, we were able to take part of it in some regards. But gold tends to go up, and then it has these volatile periods, and I think we're going to be entering a volatile period. There's way too many people are interested in it. I think probably the next year, maybe even two, it might go sideways, might even go down a little bit more. It doesn't mean I'm going to stop owning it. It just means I'm not going to overweight it. It just means that instead of having, I'm just making these numbers up, by the way. Instead of having a 10% position, I might only have like a 3% position, right? And I still would own it, but I would own a lot less. So if it goes down a lot, it's not going to hurt as much. You want to own more when it's going up, and you want to own less when it's going down. So if you have a portfolio and diversified, you should think of it in the same ways, right? If you have, let's say, utility stocks and you've got technology stocks, if you look at the weighting of the index, then there's a certain weighting there. Now, there are times where maybe you want to be more utility stocks. There's times you may want to be more technology stocks. And you can alter that. It doesn't mean you get rid of one or the other. It just means that you balance it according to what's doing well versus what's not doing well. Technology stocks have done well for the last 2 months. Will that continue? I don't know. I wouldn't think so, but they might. What about utility stocks? I don't know. Interest rates are going up. Maybe that's not the place to be either. So you have to figure out with your portfolio what your allocation is. And there's some times where it's just okay to just say, I don't like the game, I'm going to sit in the sidelines. I think this year is one of those years where if you're a day trader and you're trading in and out, maybe you can make money. But if you're a smart, wise, strategic investor, as I like to think I am, sometimes it's okay to sit in the sidelines and just watch from the sidelines, just watch a good game. I think it's interesting to watch, but people are going to get chopped up this year. Every hedge fund manager I know, every smart portfolio manager I know is completely underperforming the index. Why? Because they're smart. Now you might say, well, yeah, but the indexers are making out. Yeah, but if you're smart, you're not making dumb investments. And putting it all in semis and hoping it goes to the moon, in my opinion, is dumb. It doesn't mean you ignore it. You can invest some, but you don't put it all in black and just say, all right, let's see what happens. You got to be strategic with it. There are times to make money and there are times they're not. The last 2 months, great to make money in semis and technology, but that might change. Then it might be oil or it might be, steel, whatever. Things change. And if you're not focusing on risk, you could lose a lot of money. Now, people got really excited last year because virtually everything went up and made money. But the problem is it doesn't continue necessarily every year. It's not happening this year. This year, it's the opposite of that. So be very careful about how you are investing this year and don't go overboard. Focus on making investments that are strategic, that work for you, and are not going to cause you to lose a lot of money. Now I touch on 2 or 3 things and hand it back to Doug. All right. So here's a chart I want to touch on that kind of illustrates the point I'm talking about. Okay. The kind of gray line is the S&P 500 return as of the end of May. It's negative 0.66% return. So it's negative for the year. And if you include AI stocks, it's up 10% for the year. Well, or I'm sorry, as of March 1st. Okay, that's market went down, went up. So as of March 1st or 2nd, whatever it is, I'm not sure. But anyway, the end of February, beginning of March, up until recently. So pretty much the last 3 months. That's what's happened. So the markets haven't really changed. They're down. But if you include AI stocks, they're going to the moon. Do I think that's going to continue? I don't know. See, my suspicion, and I'm watching the game from the sidelines, my suspicion is I think that when SpaceX goes public and Anthropic goes public, that's going to mark close to the top of the market. And the reason I think that is because these are enormous companies, or at least SpaceX is. I don't know the price of Anthropic and ChatGPT, but I imagine they're probably going to be large.
They both have expected huge mega market caps. So yeah, they all are. I mean, nothing's like SpaceX, but you're right, they're huge.
Yeah, I don't tend to follow IPOs because I think it's like going to the casino and assuming that you have an edge. You know, like you're a fool if you go in thinking that you're going to beat the casino. And I think the same thing with IPOs. And here's why. When a company, let's use SpaceX as an example. So when a company starts, they raise capital, right? So Doug starts a company, raise capital. He says, Kirk, I need some money. I say, sure, Doug, here's some money. Go grow the company. And now the company grows. Doug's making a lot of money. I'm making a lot of money. Then we go get a few other people. You know, we get Phil, we get Barb, we get a few other people investing. And finally, we get to a point like, you know what? This company's really worth $1 trillion, but somebody's willing to pay us 10 trillion for it. Let's take it public, right? And let's cash out. Let's cash out, make all our money, and then we can go on our merry way. So we do an IPO, right? And then everyone steps up and just says, I want this. Oh my God, it's going to go to the moon. It's great. And then Doug, Barb, Phil, myself, we all say, all right, here's our shares. Go have fun. And then the stock crashes, right? And then we can always buy them back. The point being is you don't take a company public if it has a lot further to go or unless there's a reason for it. You only take it public if you're getting an egregious sum for it. That's why you take it public. Because Elon Musk knows, why did he take Twitter, or now, X, private? Because he didn't want the public scrutiny. He almost took Tesla private because he didn't want the public scrutiny. So why is he taking SpaceX public? Because people are going to overpay for it. And so when you think about IPOs, it's really a fool's errand to buy the shares. Now, I'm not saying SpaceX is going to go down. I'm not saying it's going to go to zero. I'm not saying any of that because I don't know. But I do remember Facebook. Facebook, when it went public, was overvalued. And it ended up going down, I think it was like 40 or 50%, within the first 6 months. And then they said, hey, we're going to start doing ads. And that's when it started to go up again. But it just kept going down because it wasn't making revenue. It was just an idea at that point. And then they started selling ads, and then it started making revenue, and then it started to go up. Point being is, I'm not saying that's SpaceX's model, but you have to understand that things don't always operate like you think. SpaceX could be a great company. It could change the world. It could. We don't know. But what we do know is that a lot of people suspect it's overvalued, myself included, and we're willing to wait for a good buying opportunity, which eventually will happen. Does that mean you don't own it? No. I mean, you can own 1%, or you can own 0.5%. I mean, I might just buy some just to have it, but generally speaking, I think it's going to be going down. Now, not all companies do that. Google went public and kept going higher continuously. So it's not every company that does that, but you should be aware that it's very overvalued. The market is at an extreme level, and people do think that things are going to start to turn around, and maybe the market sag a little bit after the IPOs, and it's not all positive. So I would just be careful and don't get rug pulled on this, and don't get sucked into the game that everyone else is playing. Um, I'm also going to point out, I saw two other charts I thought were interesting. First one is this. So this is renting versus buying cost, single family home of owning versus renting. Now, if you look at this, what you'll notice is renting is the blue and the black is owning. So it's a lot more expensive to own than to rent. Now you might look at this and say, all right, well, it's even more so than 2008, sort of. Now, this is a little bit of a chart crime, and at the same time, it's not. Now, if you're looking at this chart, what you're thinking is, and I'm just going just by first perception. I see this chart. What comes to mind? I see this huge gap between owning and renting. You know, owning is around 3,500 a month, and renting is right around 23,500 a month. So, you know, that's a big gap, right? It's a huge gap. And then you look at 2007, 2008, it was like, let's say 1,900 to 1,200 or 1,300, right? Okay, well, that's a smaller gap. Visually, what you see is, oh my God, it's crazy right now. However, think of this in percentages, because in 2008, percentage-wise, you were paying somewhere in the neighborhood of 60% more to own. I could be wrong, so just don't hold me to these, but let's say 60% difference. And right now, it's maybe 40% difference. But the numbers are more. Yes, but you're making more numbers, you're making more money. So you have to think of things in percentages, right? Don't think of things in absolute numbers, because inflation has caused everything to go up. So my point is, the percentage is still bigger in 2008 than it is now. It's still a lot, and it looks like it's peaking out. I don't know if that's the truth or not, but you should be careful owning versus renting. Like you've all heard, I bought a house 6 months ago. I'm pretty sure I picked the top. I'm convinced that I picked the top of the market, okay, in buying. Now, I'm in Massachusetts, so it may not be the case. But point being is, I would just be very cautious. Don't take my decision as a good decision. It had nothing to do with finance. It had to do with, you know, the
Congratulations, Kirk, as a value investor.
Yeah, thanks, Doug. I don't do what I say, don't do what I do. Let's just put it that way. But I just wanted to share this chart because I wanted to share, because it is popping around a little bit. And yes, I do think that the owning is peaking, but at the same time, it could keep going higher. And I just wanted to share the chart crime because it does pop around once in a while. I didn't want you to get sucked in. And then the last chart I want to share, and I'll give it back to Doug, is this one. And I saw this, and I was like, this is great. This is really interesting perspective on technology. So I share this, and for the audio viewers, I'm gonna talk you through it. Now, so there's basically three different eras. 2006, 2007 is the AI infrastructure boom. 28 to 30 is the power bottleneck, and then 30 plus is the application layer. Now, the way this is laid out is which stocks are doing well at which points. So right now, this year and next year, AI chips like NVIDIA, Broadcom, Marvel, Intel. You got memory like SanDisk and Micron. You got photonics like Corning. I don't know the others. You got networking. You got AI infrastructure like Dell and Taiwan Semiconductor. I'm sorry, what's this? Anyway, IREN. There's a few of these I don't recognize. Then you got the next era, which is the power bottleneck, which is the grid. You've got electrification. You've got copper. You got rare earths, and you got nuclear. And then the 2030 plus, you got robotics, autonomy, defense, and space. Now, I bring this up because really these are the big trends right now. Yes, sure, we've got crypto in there that's still going on, but that's kind of an older trend that's been going on. Now, if you want to look at the next trends, these are the things people are looking at, right? I mean, copper is a big one, but copper is close to all-time highs, but is it going to spike? Maybe not, and I don't think we're quite there yet. You know, we're looking at the power bottleneck, but nuclear, in my opinion, is one of the best, with the easiest no-brainer layup trades to make. Now, is it taken off? No, it's kind of been going sideways for a while, and it's still not. It's still not at its peak form. I have some involvement only because I want to keep my fingers on the pulse of it, but I don't think people have really bought into the nuclear story yet, and it's still early, it's still really early. Um, do I think all the grid? Yeah, I mean, there's some of these I think will do well. I mean, right now everybody's excited about space. They're excited about robotics. There's one thing in here that's not showing up, which is quantum. Everybody's excited about quantum. I don't understand quantum yet. I don't know that anybody really does, but everyone's excited about it. The defense sector, I don't know. To me, that's not holding its water right now. But if I look at all these, I say which are the ones they'll probably all do fine. But what I do worry about is, at what point are they really going to hit their stride? Well, right now, AI infrastructure is hitting its stride. You can see like the I forget what people are calling it. They're calling it the actually, let me bring up the chart here because I have it right here. Here it is, the Parabolic 7. Somebody made this up and I thought it was funny. The Parabolic 7, Marvel, Micron, Intel, Dell, AMD, Broadcom, and SanDisk. Parabolic 7. I don't think that's going to hold weight. Someone's trying to do some marketing, but I don't think that's going to hold weight. I think there's plenty of stocks that also are doing that. But point being is that's what's going on in the world, right? You got everything else, and then you got a handful of stocks that are just killing it. I'm not sure I'd be chasing these at this point, but I do think that this is a good image to follow to just see like what's happening in what areas and at what parts of the cycle you think they are. Because robotics is still really early. We don't really have robotics doing anything. We have some. I mean, iRobot's been around for a long time. They sweep the floors and do simple things like that. And they've got some military applications, but we don't have them in our homes yet, other than the floor sweepers. But in general, we don't. That's not a huge part of life yet. So it doesn't mean you don't get involved, but if you get involved too early, you could lose a lot of money as well in the interim. So just keep that in mind. So I would just say, just take a look at this sheet. It'll be on the website if you're listening to this. I'm not going to go through them all, but just take a look at it, grab these stocks, check them out, follow them, see how it goes.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Doug, final thoughts from you.
Yeah, so I wanted to just kind of add really quickly, since you were talking about housing and your great timing investment. Housing is more expensive on that chart than renting is right now. Everybody listening, keep in mind, none of that is also taking into consideration the other things that are really important to understand about housing, which is we have rising property taxes, rising homeowners insurance, utilities have gone through the roof, and utilities you're going to pay those renting or on housing, but generally on housing, you're typically going, when you look at renting versus housing, they're not talking about renting a full-size house versus owning a full-size house. So, you're going to have more space to heat and cool. So I think the most important thing to remember about housing is the main purpose of getting housing. And this is also why the numbers have said over time that it doesn't necessarily appreciate anywhere close to much more than inflation. You have to keep in mind all the other costs that go into it. Housing is often going to be more expensive than renting, even when the cost of the monthly mortgage or housing cost is equal to renting. You're going to take on all of the burden of maintaining this depreciating asset. I mean, I'm looking at my driveway crumbling right now. I've got settling on foundation. We had to replace a roof. We've got we've got all this maintenance to the outside. You don't have to deal with that with renting. So if you're going to make a purchase or a decision around housing, don't make that decision necessarily just always based on cost. Understand that whether you rent or you buy, you're just paying for a place to rest your head at night. And ultimately, at the end of the day, it's you're making a long-term decision for mainly emotionally based off of what we've based on what you've already or what you need that's going to be best for your lifestyle, not necessarily as an investment. One thing I did want to show here, I think that's really important to note, is I know you were talking about gold. I'm sharing something here that now is showing the composition of global official reserves. Something pretty major happened this past week as we are starting to continue to see U.S. Treasuries, bond yields continue to spike, something that needs to be watched very closely. Gold has now surpassed U.S. Treasuries as the number one reserve for global central banks. It now, as of the beginning of this month, accounts for 27% of global central bank reserves. A year ago, it was only 20. So that tells you. So yes, I think there's caution on buying into gold, but there's still, when we look at supply and demand, there is a massive demand right now of global central banks to swap out treasuries for gold. There's still a lot of demand pressure on gold. The ECB confirmed the crossover this week. It's the first time that gold has held a larger share than U.S. government bonds in 30 years. There was an article that was put out recently. I'm trying to remember who wrote it. I'm just going to summarize it. I don't know, again, articles are written to get clicks, but I think it is an interesting take that when you are looking for investing, I want to go back to Bitcoin for a second. I think the biggest thing to think about with crypto and Bitcoin, and by the way, I do want to say, Kirk, Zcash is down 50%, leading this crypto crash. So for all of you Zcash investors out there, I'm sorry for you. You're having a bad day. There's so much crypto out there that nobody's ever heard of. Sorry about the Trump coin. I just hasn't, the name just hasn't been able to carry it. But I wanted to say this about Bitcoin and crypto. I think, everything we're talking about with these cycles, the one thing that you have to just walk away from, and again, the gold, you've got your Peter Schiffs, your gold, gold is everything. And you've got your crypto is everything, people out there. And at the end of the day, I think one of the biggest things that has to just be ignored is crypto was sold, Bitcoin was sold as a replacement for currency. It was sold as a store of value. And I think we just need to blow that up forever. It is not a store of value. Nothing that's a store of value is going to fall back by 75%. It has been treated, and there's nothing wrong with this, but you just need to call a spade a spade. It is a speculative asset. People are not buying it to be the replacement of the dollar. They're buying it to be an inflation hedge that hopefully will become something that will rise in value where other assets decline. That is strictly investing. So let's stop looking at this as a currency, stop looking at it as a store of value. and understand that it is something that people are owning because of wanting it to be something that goes up in value. And where I'm going with this is, I think there's a conclusion coming that, that's starting to maybe be realized, is that we've always looked at, investing as, where can we compare something against something that is considered to be a safe haven. And U.S. Treasuries for the longest time were considered to be that safe asset. And there is starting to become a belief, especially when we look at interest rates, we look at the dollar, we look at U.S. debt, we look at the replacement of the U.S. Treasury on the composition of global official reserves, that we may be entering a world right now that is possibility, whether or not this is a long-term trend or not, that losing the U.S. Treasury bond as the reference rate and lodestar of global finance, leading to higher U.S. borrowing costs, making the rest of the world a riskier and potentially more challenging place. We may be losing a world in which there isn't an easily definable safe asset. Okay. And ultimately, at the end of the day, right now, whoops, sorry, got a call coming in. Cash. This is something where I think if we're looking, again, going back to, are bonds the place to be? Are they the place to stay? To look at. Again, cash may be your best friend right now as the place to look at. And then when we're building out your model for how your financial household should look, this may be one of those things where you start to reallocate and say, hey, it isn't necessarily going to be, I'm going to have bonds or I'm going to have cash as part of the investment. It actually may be one of those things. And when I look, and I've talked about this before from a framing of retirement income, what I call the farm, the things that go up and go down, that's your field. That is going to be, you're going to have times in which you're going to see locusts and drought, and it's not going to be a good time to be dipping onto that field. You're going to be digging up the seeds, eating the seeds, and you may not have recovery. And that part of the future of designing your actual your financial plan may actually evolve around trying to create more income streams, because in this world we used to live with pensions. Income streams are the cash where you can rely on every month, and that is your safe haven, because if it comes in and you can depend on it, it's there. So to close up everything today, I think there's one thing today's conversation should make clear. It's everything is connected. We talked about jobs data, interest rate, Bitcoin volatility, IPO activity, the replacement of the U.S. Treasuries in terms of global reserves. None of these things exist in isolation. At my company, Mergent Advisors, we look through this, what we would call the one plan. And I'm actually going to, I want to open this up here, and I want to, move, actually, if I could sit here, let me download this for a second. And then I'm going to move this, open this up, because I think it's something that if you can share it here, Kirk, give me a second. I should have downloaded this earlier, but I'm going to do this now. I'm going to pull this over here so you can share it, if you don't mind, Kirk. But the one plan ultimately is designed to look at this through a world of, looking at real financial success, not through reacting to headlines, but coordinating everything into one strategy. So cash flow, that's your reservoir. Enough liquidity to handle this volatility, or are you faced to react at the wrong time? Tax planning, the route map. Are you taking the most efficient path? Are you losing money unknowingly or unnecessarily through wealth transfers? Taxes, inflation, quietly eroding progress. Wealth building, as I mentioned, the farm, the silo, silage. That's where the word comes from. If you've ever driven down the highway and seen these mounds that are covered in tires, those are where farmers are taking old feed and letting it sit there, so in case they have, they need it, they have feed for their cattle ready to go. Those assets, are they, that you have in your investment world, are they producing income, or are they just sitting there hoping that the market cooperates and then finding you need it when it doesn't? And then, of course, estate planning. There's your vault. If something happens, if everything is protected, structured, and is it ready to transfer the way you intend? Most people don't have a market problem. Most people actually have a coordination problem. And at Mergent, it's simple. We assess, we align, we implement, we monitor and realign, because those markets, they're going to change, but a coordinated strategy is going to adapt with that. Most people are watching what the market's doing. Very few understand what their plan is doing. And so if today's conversation made you think about how all this connects, your income, your taxes, your investments, your future, your major expenses like college, take a step back and look at the full picture so that you can adjust with the world that is constantly adjusting. Visit us at mergentadvisors.net, MERGENT, mergentadvisors.net, MERGENT, because it's not about predicting these markets. It's about building a plan that works no matter what the market does.
Awesome. Thanks, Doug. I appreciate you coming on this week.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.